Hello everyone, welcome back. We're breaking down the market and showing you how I deploy the final two indicators in this three-part ALO suite series. This past Friday, this sharp red candlestick, did it catch most traders off guard? That's exactly why, when navigating the market, absolute risk management remains vital. I know many of you actively trade options, just like myself, but when executing complex option setups, blindly looking at the macro trend simply isn't enough. Or based on option premium, and perhaps some of you aren't fully optimized yet with options Greeks like delta, gamma, or theta metrics. But regardless, when executing options, your ultimate objective is capturing maximum efficiency within a strict expiration window. Because of that, I engineered a proprietary framework to map out market structures prior to entry, allowing me to fully quantify and maximize our theoretical upside. How much can that price action achieve? Maybe ensuring that over a standard horizon, price action remains bound within predictable parameters. Operating under this strict rule set allows me to confidently deploy capital while fully locking down my mathematical risk-to-reward metrics. Without further delay, let me break down the actual workflow. What you are looking at right now is the proprietary ALO Options Attack and Defense Zone, a core engine of my ALO Quantitative Suite's TradingVeiw indicators. Now, mapping this directly onto our active charts, what exactly does this metric isolate? This engine dynamically calculates statistical boundaries using deep historical performance modeling. Over the immediate trading horizon, we can accurately project this specific asset's realistic price distribution boundaries. For instance, I want to buy a 14 days option. Heading into expiration within this 14 days, what is the statistical maximum cap based on historical modeling, and what constitutes the absolute floor? How do we calculate that volatility? I engineered this precise logic framework that projects seamlessly on screen. Take our current setup on QQQ. Suppose I want to buy a call. For this upside exposure, historical data shows a 14-day maximum excursion of up to 16.43%. Conversely, if last Friday triggered a highly bearish price action signal and I choose to buy a put, the modeled maximum downside trajectory sits at minus 8.58%. Ultimately, this provides a highly definitive roadmap for your positioning. So, exactly which strike boundaries optimize our probability of success for a call or a put? Now, suppose I decide against a 2-week horizon and want to extend the tenor, for instance, buying a contract with 1-month expiration. Then our risk parameters shift completely, don't they? Because if you acquire a 1-month call just recently, during the late April upside expansion, the actual movement reached 28%, aligning perfectly with our on-screen data. Within this granular interface, I can dynamically adjust the target cycle, selecting any specific option's expiration date. This provides an objective look, backed by deep historical modeling, at how price distributes across these specific zones. For instance, when evaluating short exposure, there is a distinct mathematical probability, not a guarantee, but a statistically modeled outlier risk, of a downside expansion nearing negative 10%. Could it breach that level? Tail risk always exists. Therefore, options trading is entirely about managing probability. Once you define these exact boundaries, your execution decisions become purely objective. Now, many advanced traders don't just do naked calls or puts. For instance, they prefer underwriting options, treating the strategy as income stream. This represents the inverse positioning, which is why I classify it as put defense or call defense. Suppose you look to underwrite one contract, whether call or put, where theta decay aggressively begins accelerating past the 60-day horizon. To underwrite these contracts with maximum safety, if the spot price is 716.07, where should your downside cushion sit? Statistically, dropping your strike to $583 provides a highly resilient safety margin. But one may say, no, we're in a strong uptrend, so I think it might go up to 645. Historical support cluster forms here, allowing you to make decision. If your objective is a structural floor that price is statistically highly unlikely to breach, the 585 level offers massive insulation. When writing options for premium collection, avoiding breach is paramount. We require deep out-of-the-money targets. This logic optimizes my execution. allowing me to systematically scale parameters based on the asset's active implied volatility surface. Also, I want to look at the expiry date of the option so that I can understand the range where I can attack, that is the shaded range here. For our defensive configurations, the structural zones where we underwrite calls or puts, the parameters plot completely outside this solid boundary line for clear visibility. This framework handles more than broad indices. For instance, take a look at Tesla. Anticipating that a SpaceX IPO could act as a structural catalyst for Tesla, driving massive implied volatility expansion. In a scenario like this, I would deploy a short-term 7-day DTE contract. As plotted here, within a compressed 7-day window, the maximum expected distribution spans up to 25% bidirectionally. Armed with this definitive data surface, you can systematically structure your positioning, whether deploying long puts, long calls, or opting for risk-mitigated strategies like covered option structures to efficiently harvest premium over time. That way, you consistently maintain a mathematical edge. Next, how do we optimize our look-back window for historical backtesting? Because across different equities, structural regimes rarely remain uniform over a 12-month macro cycle. For instance, Tesla exhibited a definitive macro downtrend over the trailing 6 months, while pre-IPO assets show nonlinear volatility. Therefore, if we dynamically compress our look-back parameters, it's evident that for Tesla, compared to the prior year, realized volatility has severely contracted over recent months. Its implied volatility is exceptionally crushed now, as displayed. If we restrict our baseline model to this trailing 6-month window, the calculated historical volatility is remarkably suppressed. The variance is immediately clear, correct? Under our initial 1-year macro baseline, the boundary reached 25%, whereas the trailing 6-month sample isolates it near 20%. As your model parameters become highly localized and precise, you gain total clarity on exactly where to deploy your call and put structures. Layering in the supertrend indicator, notice how Friday's downside momentum immediately found liquidity right at our 1-year macro support cluster. Yet dynamically, by yesterday's session, price recovered but resisted by 42 EMA. Concurrently, our proprietary trend metric confirms that systemic momentum continues heavily favoring the downside. Tactically, the moment last night's session confirmed a firm structural retest of this 1-year macro baseline. My execution was deploying a short-term, 1-day-long call option. This precisely positions me to capture a very high probability mean reversion, targeting an upside expansion to 42 EMA. So this is my introduction to the ALO option attack defense zone. Next up, it's about how I manage all my options. TradingVeiw, a useful tool. Now I am proud to formally unveil our 6th proprietary engine. This institutional tool is titled the ALO Options Tracker Max. The architecture was designed out of absolute necessity, because like most of you, Optiogen's trading forms the core of my portfolio. This master engine tracks up to 15 active complex strategies simultaneously. Let's systematically dissect each modular feature one by one. This Options Tracker Max helps me manage all the options I'm currently trading. Let me open one up to show everyone first. So this here is one example. The purpose of this Options Tracker Max is that I can input details of the options that is in play. To demonstrate the interface, let's log an asset, specifically QQQ. During Friday's aggressive downside expansion, our predictive models flagged an asymmetric opportunity, systematically signaling that a long call execution was highly viable. So heading into the closing bell, I structured a vertical debit spread targeting the 708 and 735 strikes specifically. As displayed on screen, the inputs are highly intuitive. Selecting this field populates the entire architecture. For this specific campaign, I deployed a defined risk bull call spread, scaling into our targeted contract allocation seamlessly. How much was the premium? First, the strike 1 parameter represents my primary long leg. Currently, it's anchored at 708. Following yesterday's closing print at 716, pre-market trading has pushed it to 719. Consequently, our position enters the opening bell deeply in the money with a 120% net gain. Crucially, the short leg of the architecture is logged as strike 2. If you are executing a naked long call or put, leave strike 2 blank. However, for multi-leg spreads, this field is mandatory. Finally, the next key variable is the contract expiration date. Toggling this interface control expands our active panel. revealing that our specific contract configuration targets a Wednesday expiration cycle. We're just doing a 3-day option, and in addition, it's a directional spread with the 2 strike prices, so that I know mine. Whether spot price has successfully penetrated our optimal target zone, and critically, from a strict risk management framework, where our defined structural break-even threshold lies. At which price level do I reach break-even? Right now, the price has exceeded the break-even threshold already. Last night, I already done partial profit taking. So here, it also shows where my entry price is. You have to input it yourself. And this one here is something I engineered for myself, and I think it's worth sharing with everyone. It shows the price trajectory. The engine maps our precise historical entry coordinate alongside the real-time percentage delta remaining until break-even. Basically, in that 708 long leg, meant we required an immediate underlying move of merely 1% to clear our risk threshold. And I will close this position to lock in profit if we gap up in the opening. And finally, it comes down to these: the execution date and contract expiration. This structural data matrix scales across 15 dedicated columns. If you have more than that, I will show you the other ways to handle it. Let's demonstrate how to manage highly targeted playbooks like the SNDK framework using this interface. Following Friday's intense market-wide sell-off, I triggered an active entry. Anchored near the session low at $1,520, I initialized a vertical bull call spread across the $1,540 and $1,720 strikes. With spot price accelerating toward $1,690 pre-market, the structure has drifted deeply in the money, yielding an immediate 70% return on capital in 2 days. And it is likely I can reach the maximum profit within this week based on price action. There is 8 days to expiry. I opened it on last Friday near close, and it will expire this coming Friday. So, very likely, right? I also have a very good chance to achieve the maximum gain in this case. Beyond that, our indicator allows a multi-directional approach concurrently. Call spread alongside with a credit-covered put, as shown here. On an earlier date, I initiated a short covered put. I actually initiated this position after its earning day. Now, what does the percentage here you see represent? As of today, because the ALO Options Tracker Max computes in real time any underlying price movement, dynamically recalculates our break-even boundary delta, currently SNDK would require a severe 36% drop to breach our structural floor. With contract expiration arriving this Friday, that tail risk event remains highly improbable. Consequently, this multi-leg structure should expire entirely worthless, allowing us to retain the maximum credit premium. Another ticker I want to highlight is ASML. While it isn't a heavily crowded retail ticker, it represents a highly efficient options vehicle. The structural trend remains exceptionally well defined with robust liquidity, despite demonstrating higher levels of daily realized volatility. To give you a better idea, so for example, when we look at this specific call, T5 slot, and I want to show everyone more about the other features here that our architecture has preset it. The interface surfaces critical telemetry because when deploying capital, quantifying your upside profile is paramount. While naked long calls offer theoretical infinity, my preference leans toward vertical spreads. This allows the tracker to immediately calculate maximum profit, maximum capital at risk, and the net reward to risk ratio. This metric mathematically defines the exact risk capital you are committing relative to your targeted potential return. And here as well, this green one is the bull put spread. For this bull put spread, ASML would have to drop by 21% before reaching my structural floor. While for this call spread, I opened at the beginning of May, it has already passed my upper strike. Which was my estimation, was I initiated this position, so very likely I'll be getting the maximum return on this trade upon expiration. This indicator delivers immediate clarity across our active portfolio exposures. For instance, when liquidating a specific call position, toggling its status instantly refines the architecture, providing clean, high-level structural visibility at a single glance. That's it, you can actually customize everything, such as these. line thickness. You can switch to the dot line now. In short, whatever you feel comfortable watching it. Furthermore, managing extensive positions can clutter your visual workspace, which is fully customizable. As noted previously, if your operational requirements scale far beyond 15 active strategies, say up to 30, the resolution is remarkably streamlined. Simply duplicate the indicator and paste on the same chart to instantly expand the terminal's processing capacity across your active portfolio. Now you have 30 active tracking slots ready to go. Inside the ALO Options Tracker Max, I built a master ticker table. Once you type in your contract details, the dashboard automatically syncs and brings up those specific position metrics whenever you switch between different stocks on your screen. Like for this GEV, inside there, your records are already saved, so it's very convenient to use. And it's also in real time. I used one of mine for this. I rely on the Option Attack Event Zone to map out my risk profile alongside this Options Tracker Max to manage my active trades. That combination keeps me completely aligned with the market. If you blindly follow random alerts to buy a call or a put, you have no real grasp of your actual probabilities or risk exposure. But with this system in place, you gain total clarity over your portfolio. It shows me exactly when to press my advantage and when it's time to scale back and play defense. This system handles my risk management, and my goal with this 3-part video series is to pass these exact tools along to help protect and grow your capital too. The toolsets inside the ALO suite reveal exactly how I execute trades, time market dips, and analyze the macro trend to give you an edge. If you want to elevate your trading, the link is right on my profile. Head over to subscribe to my store, or look up my indicators directly on TradingVeiw. I keep everything updated regularly, and as a preview, I'm baking a brand new 0DTE tool and an optimized MACD entry system under ALO Suite. Make sure to subscribe to follow along. In the next video, I'll take a deep dive into how I manage my trades recently during volatile market. Thanks for watching, and I'll see you there.